Hello and welcome to Switzer Investing. Thanks for joining me. I'm Peter Switzer. On tonight's show, I've asked Adam Dawes of Shaw and Partners to look at the stocks that he thinks are good value stocks. Value stocks tend to do very well when a market goes into a crash, an economy goes into a recession, and then value stocks seem to outperform growth stocks for a few years. Last week, I looked at a fair few value stocks. This week, I've got Adam Dawes giving us his best offers when it comes to value stocks. And then I got Mike Gable from Fairmont Equities to look at some of the stocks that were mentioned last week as being good value stock buys to see whether the charts actually endorse those selections. And, given the fact I have already interviewed Mike, they pretty well have endorsed those ones. So worth having a look at Gable's analysis. And then poor Rickard looks at the big miners, BHP, Fortescue and Rio, and evaluates whether they are probably oversold at the moment. He also gives his view on Sydney Airport that's received a bigger offer. Is it worth hanging on to and waiting for that offer to come through, or should you sell it in advance? And then Julia Lee is looking at the stocks that she's recently bought and the ones that she's dumped. And she also looks at a number of really good and interesting stocks that are worth thinking about, given the fact there's going to be a reopening of the economy as we get more vaccinations happening. So that's the show. Let's kick off with Julia Lee from Berman Invest. Thanks for joining us, Julia.
Great to be here, Pete.
So the market's been a little bit dodgy lately. The Americans had 5 days of downside, but when you look at the whole week, it wasn't much. I think it was down about 1.6%. Are you expecting a bit of more volatility for us and a bit of downside for a while?
I think when you've been in the markets, you come to expect that there will be sell-offs from time to time. And looking at September, and September is actually the worst performing month for the Australian share market. So looking back on the last 20 years, and September is the absolute worst month with an average return of minus 0.9%. Having said that, October, although it scares a lot of people, tends to be a very good month. In fact, a top 5 month for the Australian market, so a bounce back of 1.1%. And sometimes, when you see the market selling off and starting to correct, you get quite nervous. But, despite talk of tapering and stagflation, there's still quite a bit of cheap money out there. And here in Australia, we're looking at potential reopening, which will drive economic activity in the short term. So look, I think any pullback here will be healthy and an opportunity to accumulate.
Yeah. I know last week I had a quick look at what the American market has done. If you compare where they are now to where they were before the coronavirus crash, they're up about 34%, but we're up about 5%. So I think we've got some upside to go across 20.
The Australian market's up a bit more than that, but it's been a phenomenal run. We've had 11 consecutive months of gains on the Aussie share market, and Pete, that's something we haven't seen for the Aussie share market since 1942 to 43. So Julia, it's been an incredible run.
What I was saying was, if you go back to where we were before the crash,
the record high,
you see how much we've gone up. We're only going up 5%, but staggeringly, the Yanks are up 34%. Crazy stuff. So they're due for sell-off. I don't think we are, but we probably will follow suit. Let's go to some of the important areas you want to talk about. I did ask you to rate the big miners. A lot of people are asking me, are they in the buying zone? What do you reckon?
Yeah, look, I think the short-term outlook's looking pretty good for the big miners. I think the sell-off's been too severe. So in the short term, I think you will see a bit of a reversion to the mean and a bit of buying coming through. I'd probably prefer the diversified miners here, and that's because iron ore, I think, is going to be a little bit, we are going into a seasonally weak season for Chinese demand, but I think it is going to be weaker than normal. The Beijing Winter Olympics is next year in February, and I'm sure they want to see some blue skies instead of smoggy skies. And unfortunately, that means for Australia that they'll probably be looking at curbing steel production to get those blue skies. So look, iron ore is probably going to stay weak until the first couple of months of next year. So probably after Chinese New Year, it will start to strengthen back up again. But in the short term, I think the iron ore miners, the sell-off's been overdone. So we're due for a bit of a bounce, which I think has slowly started. And I guess Fortescue would be in for the biggest bounce short term, but has probably the weakest outlook of the big majors in the medium to longer term. Having said that, I still like lithium. We've got both Orocobre and Pilbara Minerals, and that's because the electric vehicle story means that, you know, the demand is a lot stronger than supply at the moment. So the short to medium term outlook is looking good here.
Okay. What about mining services? I know Rudy Philippek van Dijk last week brought up Monadelphous, and I always love the way he pronounces Monadelphous more than anything. But over the years, he's always liked that stock, and he's often got it right. And I think even you've liked Monadelphous in your time as well, haven't you?
Yes, I mean, Monadelphous is seen as the gold standard in terms of mining services, but at the moment, I probably prefer CIMIC to Monadelphous. Only that during reporting season, once again, a key theme that came through was the labour shortages, which were mainly over in WA. And if you have a look at CIMIC, it has greater exposure, not only to Asia, but also the Eastern Seaboard with its infrastructure projects. So I think it's in a good place for strong growth. In fact, having a look at the 6 months till the end of the financial year, the work in hand was $10.4 billion. So that was up about 52% on the previous corresponding period. And then today it announced another $900 million win. So look, I think it's a bullish market for infrastructure. I think we're going to be seeing some more roads being built. And then add into the mix, you know, the Olympics, which will eventually be in Brisbane, should be good news in terms of building as well. So CIMIC would probably be my number one pick, but just watching things like labour shortages and the impact they have on profitability, because, you know, with project work, if you're offering a fixed price and costs go up, then you're going to have to absorb those costs, and a project can very quickly turn from a very profitable one into a loss-making one.
Yeah, good point, good point. Now, I also asked you to tell us if there's any stocks you've dumped and any stocks you've recently acquired. So what's the story there?
Sure. I mean, Helios is a stock that we've done extremely well on, but I've been selling Helios. I've sold all of Helios, and that's because, look, the reopening trade, the number of vaccinations, I think just behaviorally we'll probably be taking less COVID tests over the next 6 months than we have been over during lockdown. So I just think that growth might be peaking there in terms of that COVID testing and the uplift. On the flip side, there's going to be a bit of a rebalance to the ASX 200 this Friday. And added into the mix, there are a couple of stocks where I think they will be winners from the reopening, and they are Tyro as well as C-Link. So they'll be added into the ASX 200. So as soon as that announcement is made, that comes into our investment universe, and we're being very quick buyers of both C-Link as well as Tyro. Yeah,
I think Tyro actually gets in the top 200, doesn't it?
Yes, so the top 200 is our investment universe. So Tyro as well as C-Link will both be included.
And the thing is this, a lot of fund managers, particularly running ETFs, they have to buy companies because basically you got to buy the top 200.
Yes, there is that. I do still like to look at the company's fundamentals, and look, both C-Link as well as Tyro have been impacted by the lockdowns, but as the reopening happens, they should be beneficiaries. So there is still a big rotation from those COVID winners into some of the COVID losers, or the stocks that should benefit from reopening. So we're seeing that in our own portfolios, but I suspect that's happening across the rest of the market as well.
Just a thumbs up as well.
Thumbs up?
Yeah, thumbs up for Qantas.
Oh, yes, and Qantas as well. Yes, Qantas doing well. Today they had an ACCC meeting, an announcement that went against them, but I think Qantas will be in much better shape after we come out of lockdown. So looking at the next 2 to 3 years, and I think Qantas is going to be a leaner, fitter machine. So liking Qantas here as well.
Julia, thanks for joining us. Talk to you next week.
Thanks, Pete.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. And that was Julia Lee of Berman Invest. Now coming up now is Michael Gable from Fairmont Equities. And last week I did a bit of a crusade to try and work out what value stocks look like good value going forward. And a number of the stocks came out from my experts. And I then went to Mike Gable and said, well, Mike, what are the charts saying about these companies? And that's what he's going to actually report on right now. Mike, thanks for joining us.
Thanks, Peter.
Let's kick off with BHP first.
Yeah, look, BHP's obviously had a rough few weeks, but what I wanted to do was show everyone a longer term chart of BHP. So this is a monthly chart, as we could see, going back 15 years. Now, we looked at this chart earlier on in the year, and we noted that BHP was breaking to an all-time high through a very major resistance level, which was sort of in the low 40s there. So there's the horizontal blue line. We could see that up until earlier this year had been a barrier for BHP, and earlier this year, of course, it broke through that, and that's that was quite significant. So the most recent declines with BHP, it only really brings it back to about that line. I mean, give or take $1, but that general region is where BHP now sits. So I think this will be a very strong support level for BHP. I don't expect it to rally quite quickly from here. I think it may well sort of drift sideways for a little bit, but yeah, this is a pretty major level for it. So I'm pretty confident that over the next few months or so, you'll see BHP's share price improve.
Yeah, and the analysts do have a lot of faith in the company. I think the general consensus is around a 12% rise, but some other companies, analysts really like even more, to the extent that they see it being a $50 plus stock very easily. I saw one at 60, but I think that person probably pulled it back to about 55. But and after talking to Michael Knox from Morgans, he's got a very bullish outlook for 2022 and commodity prices in particular. So I think it's going to help BHP. Let's go to the next one now, and that is Iluka Resources, ILU. Gee, it's looking good there.
Yeah, look, it is a good looking chart. I think this is one we also looked at earlier in the year as well. So very nice trend. I mean, there have been a couple of occasions where the charts looked a bit dicey, such as in July, but look, overall, it's managed to continue to trend well. So the diagonal line there clearly indicates that it makes these higher lows. So every time the share price does have a bit of a dip, the buying comes in. Most recently, there was a resistance level at $10, so a bit of selling when it got near $10, but we could see today it's gapped up above that and is trading really well. So yeah, look, there's nothing, as I said, nothing wrong with the way this is trading right now. It should just continue to head higher. If it was to dip back, I'd like to see it hold that prior low near 850. In other words, if you see a dip in the share price, as long as it pretty much stays above that diagonal line, then there's nothing to worry about. So if you're looking to buy a dip to get a bit more value on Iluka, then yeah, just make sure it's above that diagonal line. But at the moment, just a nice, strong, steady uptrend.
Okay. The next one is Ramsay Healthcare, RHC. Now, this is a company that has done very well in the past, and as you can see, it's pretty well gone sideways with a kind of an inclination to be more down than up. But your chart shows it has actually snuck through that blue line. So tell us about that.
Yeah, fairly interesting. I mean, Ramsay hasn't done as well as some of the other larger healthcare stocks, but I have noticed there is this very obvious level of selling anytime it gets near $70. Yeah, basically the selling kicks in and the share price is unable to make much progress. It did sneak above that, as we could see several days ago, but the selling managed to kick in again. So basically that's the key level to keep an eye on. I think if we see it get above $70 and manage to hold there, then that would be a positive sign, because it simply tells us that anyone wishing to sell the stock at 70 has already done so and gone, and that'll mean that the shares are free to head higher. So probably too early to be buying today, but it's nice to have a stock like this where you could see a very clear level, and there's not much guesswork around, well, do I buy or not? For me, it's pretty clear. Gets above $70, holds there for a few days. That's a buy.
Sorry, mate. What I like about this is that, okay, it's high before the coronavirus is about $80 or so. And clearly this is a company that has not benefited from the coronavirus. It's a hospital business that's a lot of their sort of surgeries that they would be doing have been put on hold. You know, they operate in France, the UK, and other in Malaysia, I think. But there would have been a lot of like government interference in them making money because of the national concerns around the coronavirus. So it's interesting. I think this looks like a value stock that has some upside, but you're right. I don't think it's going to happen anytime soon. But once we feel as though open borders and countries are getting back to normal, which will probably be mid-2022, I wouldn't be surprised to see it get back up towards the 80s again. Okay, let's go to the next one. Hub24.
Yeah, exactly.
So what do you reckon?
Yeah, so this one again is a stock that looks like it should continue to trend higher. It's been a bit of a wild one, as we could see. It you know, over the course of this year, it's been as high as, you know, initially $28, back down towards 20. Some fairly wild swings, but it seems as though that $28 region, which was a major level for it, you know, that was finally breached at the end of last month. And yeah, to me, it looks like it should be able to head higher. We could see that before the breakout, it was making the higher low. So every time it did dip into the low 20s, there was some buying support. That's why I've got that diagonal blue line there. But now that it's broken out, I think as long as it could stay above 28, then, you know, there's an opportunity there to buy it. Look, it might not necessarily be one, you know, I'm not necessarily keen on a stock like this with such, you know, big swings and big volatile moves in either direction. But, you know, if you like the business, I think looking at this chart, you can be confident that you should see high levels over the next several months.
Yeah, it doesn't look like an AMP chart, does it?
Not, yeah, not much does.
No. Okay, let's go to Babcorp. Now, Rudy's always like Babcorp, Rudy Philippe Van Dyke from FN Arena. And he always thinks that the market, you know, misreads Babcorp, and he's arguing that last Thursday. What is the chart telling you about Babcorp?
Yeah, it's great business. Obviously, it hasn't made any sort of share price progress over the last year, but again, this one's got a very clear range, which is great. So at the moment, it's getting towards the bottom of that range, and you know, if it gets near $7, it's a buy. You know, in anticipation of a rally back up towards 850. I think if it breaks that lower blue line, then that's a problem, because it just means that there's, you know, not much buying of the dip anymore. So that would be a concern. But based on past experience, yeah, anywhere around here or slightly lower is a buying opportunity for a run up to 850. And then clearly, if it can get above 850, that would be really bullish, because again, it just means that all the big sellers around that point are gone, and then it's just blue sky. So for the moment, it's a range-bound trading opportunity with an ability to top up, I think, if you can see a crack above 850. Yeah.
Well, it's certainly a business that's right in the right sector at the moment. Like, cars are doing so well, aren't they? And it's in that business. All right, let's go into your pick for the week. You usually go for a company, but today you want to go to the overall market, what you're seeing. And I've written a few pieces saying that I'm expecting volatility over September, October. There's so many sort of curveballs out there, from inflation concerns and slowdowns in America and China, and tapering concerns from Reserve Bank and interest rate rises. There's a lot of stuff. Delta variant, of course.
Yeah.
What is this chart telling you, mate?
Yeah, so apologies to those looking for another stock tip, but I thought this was...
You can buy the ETF or sell the ETF.
Yeah, exactly. So look, I thought this was worth mentioning, just highlighting what's happening in the broader market. So when it comes to the index, I like to keep an eye on the 50-day. This is the exponential moving average. It gives us a good guide as to, you know, whether the market's, you know, whether we should expect some weakness or whether it's happy to continue moving higher. With our market, as we could see since the beginning of the year, it has broken that 50-day moving average. So that's the blue line following the market. But every time it's broken that blue line, it's bounced back up the day after. What's interesting here is last Thursday, that big move down did see our market break the 50-day moving average. And on Friday, it got close to the underneath of that line and couldn't get above. And again, today we're trading underneath that blue line. So I've circled that on the right-hand side. So we could see the break and we could see that our market is trading under that blue line. So I'm not saying the market's got another 30% drop or anything horrible like that. I think I agree with you, Peter, there's enough, I think, fundamental reasons for the market to do well in the longer term. But those risks in the short term that you highlighted, it seems to be playing out now in the price action. So I think that it's worth just being a little bit cautious here on our market in the short term. I think if there's stocks that investors out there like, they may well be able to get them cheaper over the next few weeks. Our market, it's impossible to know whether we just dip sort of a few percent or 10%. I mean, that's impossible to know at the moment. But what I do think will happen at the moment is there should be a bit of weakness here, just a lack of upwards movement. The US markets is trading above their 50 days. So if they break their 50-day in the next few days, then that could lead to further softness here. So just a general, be cautious, no need to dive into too much at the moment. And I think most of your favourite stocks out there, the way this market's trading looks like they might get cheaper over the next few weeks.
Yeah. And Mark, what's interesting, I think if you look at those sections where the markets trade sideways, they coincide very closely with lockdowns, don't they?
Yeah, exactly. But it looks like we've just decided to get worried about something else. And you know what the market's like sometimes. They tend to get worried over nothing and all the lemmings follow each other off the cliff. But hopefully the cliff this time's a small one.
I call it a buying opportunity. All right, Mike Gable, thanks for joining us.
Thanks, Peter.
That was Michael Gable from Fairmont Equities now. And joining me now is Adam Dawes of Shaw & Partners. Adam, good to see you.
Yes, good to see you also, Peter. How are you going today?
Very good, very good. And I've asked you to look at some value stocks that you think are priced to go on the upside over the next 6 months to a year or whatever.
Yeah.
And come up with three.
Well, did you like my suggestions?
Well, I'll tell you after you tell me, and I'll review it. You know, you have to pass the Switzer test before I give you the thumbs up. But your first one is Lendlease, which I have held in recent times. I've kept my fingers crossed.
Yeah, look, it's one of those ones that certainly I think that there's some value emerging from it. But I guess to the viewers, I'd be a little bit cautious still on this one. I still think there's a little bit more water to go under the bridge on this one. But I am looking to start putting it back into clients' portfolios. And I think the value is emerging from most of the bad news has already been sort of come into light. You know, we know pretty much where Lendlease is. I also remain cautious on the ability for them to commence on some of the developments in their timeline. But what I did like about the result from Lendlease, and this is why I think the value is starting to come out in this one, is that they announced $160 million cost out, which is about 17% of their earnings. And then basically then from there, it's looking that they will get those return on equity targets up by about 2024. But they also did say that that cost out program is going to allow them to then get greater synergies moving forward. And that's very much company speak, Peter. You would probably already know that. That company speak is that they've got a new MD in there at the moment. And the market is a little bit skeptical on how they're going to be able to actually get that work going. So I think that this one is going to be an interesting one. I think there's value there, but it just might take a little bit longer than first thought.
Okay. The one that the analysts certainly agree with you is QBE. I think they've got a 15% upside. That's the consensus view, but some even have it higher. What's your view on QBE?
Well, this one, has been a perennial disappointer to the market. Okay, no doubt about it that they are perennially disappointing the market, and I think that is one of the things that you always have to be very careful, because we've always gone into QBE thinking that things are going to be okay, but they obviously then disappoint. Now, taking a step back, car insurance, which QBE doesn't do a lot of, but I'm talking about insurance generally. Insurance generally, you know, there hasn't been many car crashes because people aren't driving anymore. There hasn't been many burglaries around because everyone's at home. So just like yourself, Peter, sitting there with at home, so a lot of insurance claims, or there hasn't been a lot of insurance claims. Now, QBE is a very big reinsurer, and I think that's where you got to be a little bit careful with QBE, because they basically reinsure very large companies, and it's all about the weather for these guys. And certainly the weather's been very hard to pick. But QBE is looking at getting some of their expense ratios, and in fact, their underwriting expense ratios is better than a lot of their regional peers. So that's a first advantage. I think their North American division, they're going to be able to get around 200 basis points taken out, and that will equate to about $80 million worth of cost savings for the business. Again, that's certainly something that I think will do very, very well. And look, QBE, again, I think the analysts agree with me, but I just want to see some more water under the bridge. But QBE is definitely looking like there's value at the moment.
Okay, let's go to your next one, AMC.
Amcor, what a classic! What a great business. There's a bit of less value because they did upgrade their numbers just, I think, 2 weeks ago when they reported. But look, consistently they're getting some fantastic EPS growth. There's around about 15 to 16% EPS growth going forward. They've got strong margins, and we're basically guiding to a better year for 2022 to 2023. I think the management are fantastic on Amcor. I think the only issue with Amcor is that raw material. So the input costs are rising, but Amcor will be able to get that going forward. Certainly this is a reopening trade or a reflation trade as well. I think Amcor, there's certainly value in there. But the negative side of it is that healthcare has dragged them down a little bit. So I think you need to be a little bit cautious about that. And when they merged the business between Bemis and Amcor, they've been able to get a lot of synergies out of that as well. So I think that's certainly fantastic. They're also doing a $400 million buyback as well. I think there's lots going for Amcor. It's a fantastic business. Sits in the top 50 stocks. I think you can't do too wrong going for Amcor at the moment.
Okay. So they're your value stocks. Do you put Telstra in the value bag, or is a company you just either like or dislike?
Well, it's something that I like at the moment. I think Telstra, after the dividend's been paid, which it has now, I think Telstra certainly has some really good value in it. They are moving in the right direction, selling assets. And if inflation starts to bite, you want to be in a business that can raise prices with inflation. And that's certainly something that Telstra can do. We saw their ARPU, their average revenue per user level, rose about 2%, 1.7%. Now, that doesn't sound like a lot, but if inflation's running at 2%, 3%, you want to be in a business that can raise prices with inflation. And I think Telstra is one that you would firmly have in your portfolio at the moment.
What kind of price target do you have with it?
We don't cover it, but most of the market has got over $4. It's currently $3.80, $3.90, somewhere around there. But as we know, most analysts will upgrade prices as the share price rises. And I think that's what will happen. There'll be begrudging upgrades coming in for Telstra in the next 6 months or so.
Okay. And your final one is GDC.
So this is a little bit of an interesting one. It's a global data center business. Okay. Where does all the data go when you turn on your computer, when you look at your emails, when you look at YouTube, or you do something on there? Where does all that data go? We've got Internet of Things. So in other words, at the moment in your household, there's probably about 12 connected devices to the internet. 5 years ago, that was about 8. And we expect that over the next 10 to 15 years, that will rise to 20 to 30 devices connected to the internet. All of that has to go somewhere. NextDC is the big guy in the room. That's the Australian component. We've got a small one. We've got a price target on GDC of around about $2.40 at the moment. It's currently $2.03 at the moment. So there's some real upside there and some real value in this due to the fact that you're future-proofing your portfolio, or it's a warehouse of the future, going forward. So global data centers, GDC, we really like that one. It's a good little play. NextDC's had a good run. I think this is time for GDC to start to move.
So it's basically trying to eat NextDC's lunch
on a global scale. So they've realized that they can't do it here in Australia because rents are too expensive, land is too expensive. So they've decided to go to France, Latin America, Guam, those kinds of things. They are raising some more capital at the moment. That's at $1.93, raising around about sort of 25 million. But what that is going to do is then that is going to allow them to go out and make some more acquisitions on that global space. And I feel really comfortable about that going forward.
Okay, Adam, thanks for sharing your insights.
Thanks. Have a great day.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Well, joining me now, as he does each week, is Paul Rickard of the Switzer Report. How are you going, Paul?
Good, thank you, Peter.
Look, Paul, I do want to actually just throw something to you around the big iron ore players. I think they're probably buying opportunities from here right now. I'm going to ask you about Sydney Airport in the moment, but what do you think about the big iron ore players? You know, just put a 6-month period on it. Do you think they're going to go on the upside or keep hovering around these low levels?
I think around a BHP in the very low 40s, Peter, there's got to be a bit of value there. I mean, in the same way that I think when everyone saw the iron ore price at $230, and particularly the sort of the run up from about 150 to 230 was in a matter of just a couple of weeks. And it's come back almost as quickly because the Chinese government is clearly giving instructions to the steel makers to whatever they're doing to cut production of steel, so that in the run up to the convention in Glasgow or whatever it is, for whatever reason they're trying to get the price down. They've been pretty successful, and I think it's the underlying fundamentals are still there in terms of an improving world economy. So I don't think I give up on iron ore yet, notwithstanding the correction in the price. And I think around $40, there's value in BHP. Yeah. I think there's also, we're seeing, at the same time, strength in other commodities still. So you've got to expect some of that will flow back into iron ore.
Yeah. My figuring also is that if you believe the economists that 2022 is going to be a boom year, once all the businesses that are closed now or affected because of the coronavirus, we'll see a boom. And that should be good for economic activity. And, the iron ore producers are likely to do better than they are right now. So it seems logical that they're going to do reasonably well. They won't shoot the lights out, but they do reasonably well going forward.
Well, remember also that no one really expected the price ever to get there in the first place. Remember that Josh Frydenberg, the treasurer, his estimate, I think, is based on an iron ore price of about $60 from memory. It might be out there a fraction.
55.
Yeah. 55, yeah. The West Australian government's got about the same, and so have the analysts, so they've been going up. No one expected it to get to 230. So even at 130, it's still well above what most people were factoring in, and that's in the analyst forecast. So I think, we're now down there. The prices come off from 55 to 40. Fortescue's had the same sort of drop as had Rio. I think there's a bit of value there. And in fact, BHP's now less than it was at the start of the year, well down on the start of the year when the price was down about those levels. So I think there's some value there, Peter. And I think the other thing to remember is the other factor with BHP, of course, is we've seen a bit of a short position build up in the local Australian stock, and that's to do with essentially the long-term closing of the separate London listing. And so the arbitrageurs have been buying the stock listed on the UK market and selling the Australian stock. And look, that arbitrage will come out at some stage, and I think there's probably a bit of upside still in BHP still.
And what about the dividend going forward? It's pretty good still, isn't it?
Yeah, I mean, certainly no one expects the dividend to continue at the same rate. And as you pointed out, I think in today's Switzer report, Peter, the dividend forecasts for next year are a lot lower than they are for this year, but they're still pretty attractive. And And, I think that that's sort of built into the price. So we just got to see a little bit of stability, I guess, in the commodity price, and I think we'll see a positive rebound. So look, for the long-term player, there's value here at the moment. If you really want to play the trend, maybe you wait just a bit longer. But I think for the long-term value player, this is a reasonable entry level.
Okay, what about Sydney Airport? You've been watching that, and they've been offered a higher price.
Yeah, what's really surprised me about Sydney Airport, and even today, Peter, is the fact they're still trading at quite a big discount to the price. And I said that the first time when the first offer, I think, came in at $8.25, I think it was, from memory. And I said, that's a really quality group of potential buyers. This is big Australian super. And then Australian Super joined in and they raised the price to $8.45 and said, that's an even better group of buyers. These guys aren't going to go away quickly. Now they've raised the bid to $8.75, and Sydney Airport said, okay, we'll grant you some rights to do due diligence. And today it's still trading at a discount. I think it's about $8.40 at last check. So, I think they're going to win. They're going to take it over. They'll pay the price. If you're a Sydney Airport shareholder, hang on. I don't think the market is giving this bid enough credence. These guys want the asset, and they've shown 3 times now they're prepared to pay up. I don't know how much due diligence you can do in Sydney Airport and discover something you didn't already know.
Yeah.
And this is Australia. This is big super Australia getting behind and saying, we want to own this asset and take it off the market. So Sydney Airport shareholders, I reckon you're going to see a bid at $8.75. It'll be all cash. It'll come to fruition, and that'll be a great exit point for shareholders.
So as a consequence of the Sydney Airport bid, have you seen other infrastructure players affected, Paul?
Well, we did initially, Peter, when it was first announced, but today it's been a bit interesting. Transurban is actually down on the day, Peter. Auckland International Airport is up a touch, but I think, what we're really seeing here is the impact of all these, the money in Australia is becoming really concentrated. We're going to end up with a small number of really powerful superannuation funds. And increasingly, Peter, they're going to want to own assets in their own right, not through a listed vehicle. So it does mean that any prize assets that are out there, and this could be not just infrastructure assets, but things like, utilities or potentially, buildings and other sort of single big assets, big super is going to get involved and going to look to own these assets in their own right. And that's got an important flow on, I think, for parts of our market. So we're going to see more of, I think, these sort of plays as big super, if you want to call it that, really says, look, we just need to own this stuff because we're so big, it's so hard to invest, and we can take on the whole thing.
That's right, especially when it comes to monopolies like Sydney Airport. Paul, thanks for joining us.
Thanks, Peter.
And that was Paul Rickard of the Switzer Report. And if you want to get more insights into how to invest and what stocks look really good, think about taking a free trial of the Switzer Report. Lots of our analysts and experts give more detailed analysis of companies that we don't necessarily discuss on the TV show. So have a look at that. It may well be in your best interest. Thanks for joining us. See you on Thursday.